Options Club. Delphian Trading basically provides, advanced market research tools and predictive analytics to empower traders with data-driven insights and strategy optimization. Their platform offers features like backtesting, daily trade ideas, and earning strategies catering to individual traders and financial firms.
Put them on and put it into the.
Oh, sorry, I'm muting them. Go ahead. You there, Krupali?
I think she's on mute as well.
Oh,
sorry, could you hear me? Yeah.
Yeah, sorry.
Yeah.
I can now.
Yeah.
Yeah. So thank you so much for providing your simulation software. I'm pretty sure everyone has access to it. And so we welcome Joseph, their chief strategist, and Joshua, the trading strategist, who will help us learn, some mock trading strategies today and help us access and how to navigate their software. I had actually spoken to Joseph, and he had come up with this brilliant idea that why don't we meet after elections, and we looked at how some stocks and some indices have fared. So that is how we are going to go about. And thank you so much. And you guys have the floor now. Thank you.
Okay, Krupali, thank you. Again, thanks everybody for making time. It's not easy. Everybody's busy. But I think we did pick kind of an interesting time right after the election. Certainly, the markets are saying something. Also, in the options world, the options industry traded almost 70 million contracts yesterday. Average daily volume in the industry is about 46 million contracts a day. That's up dramatically from 3-4 years ago when the industry used to trade, about 20 million contracts a day. So we've gone from, in 4 years, about 20 million a day to 46, 48 million a day. And yesterday we actually traded 69 million. So a lot of people using options. And, we wanted to take a little time today to go through some of the core concepts of options. Options are great financial tools. They can be really a lot of fun to use. I think, they get a bad stigma to being too complex, too complicated. And hopefully after today's presentation, you'll have an opinion whether you think that may be true or, more towards my opinion, where there are core concepts that can allow you to, employ these tools. They're wonderful financial tools. So I'll get into that momentarily. Just a little bit about myself, and then I'll pass it to Josh real quick. I was lucky enough to trade options on the floor of the Philadelphia Stock Exchange for 23 years and had an absolute blast doing that. That's back in the days when you had to change all the options quotes, verbally instead of electronically, if you can imagine that. So I left the floor in 2004 and then had the opportunity to work in an educational capacity for the industry, a group called the Options Industry Council, for 11 years. And then, more recently in the last 4 have joined the Delphian team. So that's my background. I will jump into, a slide presentation after I turn it over to Josh to allow him to tell you a little bit about himself. Josh?
Okay, thanks, Joe. Thanks, Krupali. Yeah, I've been with Delphian for 8 years, kind of like the guy that answers all the questions about the platform, kind of the platform expert. I developed a lot of the trades, the daily trades and the earnings and all that for the platform. We host a weekly meeting for clients every Wednesday, and, just kind of educate people on options and, our product, the Delphian Trading, which you guys should all have access to. So if you have any problems with that, just, email Krupali and I can get you the credentials. But, so before Delphian, I was a financial advisor at Wells Fargo and Merrill Lynch. That was about like 4 years or so. And then prior to that, I was in the U.S. Navy. I was a ship driver. So I did that for a little over 10 years. So That's it. Back to you, Joe.
All right, Josh, thank you. Josh is a man of many talents. Let's see here. We can get rid of a couple of these things. Slideshow, start from the beginning. All right, I think we're ready to go. So, today's presentation really it's core concepts, and as I said, options, if they agree with you, can be a financial tool you'll use your whole life. And as I said, I've felt real lucky to spend 23 years trading them, as a wholesaler. It was a lot of fun. And so anyway, well, we'll get into the education side and, hopefully offer some insights for you. So, core concepts. Again, I think options don't have to be that complicated at all. And if a lot of what we go through today, you understand, you're well on your way to being comfortable using options. Actually, I should ask, and I'm not sure, if you use options or have used an option before, maybe just make that comment in the chat box. It would be interesting to see how many of you have used options because, and as Josh will go through, we have a virtual portfolio on the platform. You could kind of test them that way, but the learning curve is exponentially quicker when you actually either use them in a virtual portfolio or with real live money, and not a lot of it, but if you start real small, it's amazing how quickly you learn. So some of the key questions, I think, and I'm just going to go through the questions and then we'll go through some follow-ups, but just to kind of get you thinking, what does an options contract represent? Option buyers pay for rights. Option sellers take on obligations, but get paid for those obligations. I'm pretty sure you all know calls and puts. We'll talk about the differences. Long an option, what's the risk? Short an options, what the risk? How important is the stock price compared to the option strike price? Not sure if you're familiar with the option strike price. It's critical. Is the stock or index you're talking about volatile? And then does volatility impact option prices? Different terms when it comes to options, in the money options, at the money options, out of the money options. Intrinsic value, time value, pricing factors. Many call them the Greeks. Delta, gamma, theta, vega, and rho. The stuff's straightforward. We'll go through it, but it's straightforward. Exercise and assignment of options. And then, of course, this doesn't just relate to options, but overall, know your risk in any investment. Know your risk. So here we are. Why, what are options and why use them? Okay, options are contracts. They give the buyer the right to buy or sell the underlying asset. So the buyer has the right to buy or sell the underlying asset, depending on whether you're using a call or a put. The seller takes on an obligation, for that underlying asset at a specific strike price. Okay, that's key, the strike price on or before a given date. Okay, buyers have rights and pay for them. Sellers get paid to take on obligations. We got calls and puts. We got calls and puts on indexes, equities, ETFs. Important, each contract corresponds to 100 shares of the option, to 100 shares of the underlying, and that's where the leverage of options comes in and how you can more effectively use your capital. Call buyers. You got a right, you buy an option, you got a right to buy 100 shares of the underlying. So if you buy an option, what's the risk? Anybody, want to speak to that? If you buy a call option, what's your risk? Anybody? Well, I'm not sure if we're on mute or not, but
Yeah,
the
just unmute yourselves if you guys want to. Feel free.
Yeah, if you want to chime in, feel free to unmute yourself. Just hopefully there's not too much background noise. Anybody on what's the risk if you buy an option? Okay, well, the risk, it's straightforward. It's what you pay for the option. it's just like stock, your risk is going to be what you put up. The difference is you got to put up a heck of a lot of money to buy stock versus an option, unless you're trading, unless you're buying on margin. That's the call buyer. Call seller takes on the obligation to sell 100 shares, at a specific strike price. What's the risk? When you're a call seller, it's undefined. That's the difference. Okay? When you're a call buyer, you can only lose what you pay. When you sell a call, and if you don't have something to hedge that short call, your risk is unlimited. And so that's a key factor that you have to take into consideration. Put side, same thing. The difference is you buy a put. It's not the option to buy the underlying. It's the option to sell the underlying. And you probably know that, but it can get a little bit confusing. The risk is the same as when you buy a call. Whatever the heck you paid for the option, that's the risk. Put seller, and again, it can get what's your obligation when you sell a put? The obligation is you got to buy the stock at the strike price. And, we'll get into strike prices a little bit. So what's your risk? It's significant. It's not undefined like a short call because, a short call, theoretically, a stock could go to infinity, so you can't really quantify the maximum risk of a short call. A short put, again, your obligation is to buy the stock. Let's say you short a $100 strike, okay? If you have to buy the stock at 100, you can lose $100. That's your risk. If you sell a $5 put, stock can only go to zero. You can only lose $5. Still a lot more risk, but it's not incalculable because a stock can only go to zero. Okay, that's your risk. Exercise an assignment. That is the right you buy and the obligation you take on. You buy an option, you can exercise that option, which means you then take delivery of the contracts, of the stock. Questions at the bottom. Option buyers have rights to exercise, and you pay for those rights. Okay, only the owner of an option can exercise. Sellers take on the obligation and get assigned. The buyers have control. They can exercise anytime they want. But as you can see, at least 75% of the options that trade, a long option buyer sells that option before expiration. There are a lot of reasons for that, but most importantly is this next question. What's the risk associated with the option when you exercise? So back to that $100 strike, you may have paid $5 for a call, okay? And so, you had to put up $500 because every contract is multiplied by 100. Once you exercise your risk, you have to put up the money for the long stock. So you'd have $5,000 worth of risk on 100 shares of a $100 stock. Actually, that would be $10,000 versus your $5 risk or $550 risk in the $5 option. Okay, so your risk changes dramatically when you exercise, along with the amount of capital you have to put up. That's why most contracts are closed before they go to exercise. On the sell side, when you're selling options and taking on obligations, you have assignment risk. When you're long the option, you can exercise anytime if you want to. When you're a seller, you can be assigned at any time, meaning you have to deliver the short stock. Okay, big difference. So just something to be aware of, and something that I'm sure if you don't know about it already, you will learn more about, going forward. Each contract, again, has a unit of trade, which is 100 shares. You've got the strike price, and then you've got the expiration period. It could be, an option that's expiring today, the end of this week, at the end of the month. Lots of different expiration periods. You really have to be careful about that. Make sure you know. Quick example of an option contract, XYZ would be the underlying. The time frame would be the December 15 expiration, 2024. $45 call is the strike, and the price is $5.50. You can see the underlying is XYZ. Expiration date is December 15th. Strike price is or exercise price. I always call it the strike. Some people call it the exercise. Is 45 in this example. And then the option price or premium is $5.50. But because every option contract corresponds to 100 shares of the underlying, you take that $5.50, multiply 100, you have to put up $550 for that contract. If you're buying it, you collect $550 if you're selling. Additional core concepts, this idea of intrinsic value versus time value. Intrinsic value is the in-the-money amount. We'll go through, an example of that. So option contracts may have in-the-money or intrinsic value, and they may have time value. At-the-money calls and puts, no intrinsic value, no in-the-money amounts, all, time value for the at-the-money calls and puts. And then the out-of-the-money calls and puts, they're out of the money. So clearly there's no intrinsic value, all time value. So that's intrinsic value versus time value. The calls, being in the money, I'll give you a quick example here, okay? Most importantly, the stock price, $50. So you've got your strikes around 50. You got the 40 calls and puts, the 45 calls and puts, the 50 calls and puts, 55 and 60. And in a lot of cases, you have more examples than that. So, what does the 45 call represent? The right to buy stock at 45. So if you can buy the stock at 45, but it's trading at 50, that call has to be worth at least that $5 of intrinsic or in the money amount. I hope that makes sense. And then on top of that, there's time value. And we're talking about the 45 call now. So if the call expires today, time value is going to be darn near nothing. If it's, the end of the week tomorrow, a little bit more, a month away, you will have time value. And so they're the simple concepts, that make up the value of the option. How do you price time? And this is where, to me, the fun of options really comes into play. Time basically gets priced by the amount of time, but how much volatility is in the stock, okay? So the 45s are in the money, the 40 and 45s are in the money, the 50s are at the money, the 55 and 60s are out of the money. And we can talk about, why you might buy them, later on. Puts, it flips around, so again, $50 stock price, but the in the money strikes are the 55 and 60s because they represent the right to sell stock, not the right to buy stock. So sure, if the stock's trading at 50 and you can sell it at 55, that's $5 of value. If you buy the 60 put, you got $10 of value plus time. That's how it works. The 45 and 40 puts are out of the money because they're below the price of the stock. Quick example, just to hammer home that idea, we got XYZ, it's a $53 stock, $53. We're talking about the Jan 50 calls priced at $5.50. All right, $53 stock, $5.20 call. It's the 50 call with the stock 53. It's $3 in the money. So how do you get that 520? It's $3 of intrinsic value and then $2.20 of time value. I hope you get that. That's how this stuff works. If we price a $55 call, okay, and not talking about how much time, but does it have any in the money amount or intrinsic value? The 55 call. Well, the stock is 53 the right to buy stock at 55 is $2 out of the money. So no, there's no intrinsic value. And, you know, if there is any value to that contract, in this example, it's $1.50, it's all time value. So that's how it works. Quick quiz, and then I'm going to be turning it over to Josh. Stock price 77. The 70 call is priced at 10.50. Is it in the money, at the money, or out of the money? The $70 call. Hope that's what you're thinking. Any intrinsic value? Hope that makes sense. Time value is going to be the difference between 10.50 and $7. So we get $3.50 of time value. Next, stock price 58.50 to 60 put, in or out of the money. Hope you get that. In by $1.50, right? Because you get the right to sell stock at 60. Stock price is 58.5, $1.50. The difference is going to be time value. Next one, 83 call with the 83 stock price with the 85 call is going to be out of the money. No intrinsic value. Time value 2.25 because that's the price of the option. And then last, well, we had in the money, out of the money, and out at the monies. This one is the easy one at the end. At the money, obviously, no intrinsic value at $1.50 and out of the money value. So I hope you get that. These are just, you know, important core concepts. You know, these different pricing factors. The delta is how much the option value changes with a 1-point move in the stock up or down. And, you know, there are lots of pricing calculators out there. It's important to have a sense of delta. Gamma is how much the delta changes when the stock moves up or down a point. Okay, how much the delta change? Time decay is how, you know, quickly or slowly that time value of the option goes away each day or week. Vega, all important Vega. Again, I spoke to option pricing, and that time value is priced according to how volatile the stock is. You know, we quantify what that translates to in terms of how much the option costs. If you had to pick one of these Greeks to spend time learning about, pick Vega, implied volatility. It moves all the time. It's dynamic. It's part of what makes options so much fun. And then, you know, one of the less active components is rho, which is the interest rate component. You know, you can put that in your pricing calculator. It doesn't have too much of an impact. So, you know, options, they offer a lot of flexibility. You can use them for risk management, generate income, stock acquisition, just a few ways to use them. Before I turn over to Josh, you know, Rapali, you did a great job, you know, asking everybody, you know, kind of what are they interested in? This is about a week and a half ago. You know, she was kind enough to put everything together. You know, there were 6 different stocks that the group was interested maybe in talking about, 4 different indexes. You can see how many were bullish, bearish, and then also, you know, neutral. So we'll touch on some of this as we go through the presentation. I did, you know, in terms of real life, and, you know, I want to give all credit here to Jeffrey Kleintop at Schwab. He's their global investment strategist there. He had posted this on LinkedIn the other day. Just thought with the timeliness of things, it was really important, you know, around the presidential election. You can see, you know, his homework says only 2 negative presidential transition periods for stocks between election day and inauguration day. And those 2 periods were around recessionary bear markets. You know, in 2001, after the dot-com bubble, and then the financial crisis of 08, 09. So generally, transition after, you know, the transfer of power has been constructive for the markets going back a few generations here. So again, a shout out to Jeffrey Kleintop for that. But, you know, that's where we are right now, going through a big political transition, and generally that can be good for the markets. Last slide here, something I want you to always pay attention to. Earnings matter, okay? These are the earnings of the S&P 500 from 2010, looking forward to 2026. I've got 24 and 25 highlighted. You know, I'll pull out some charts later on if there's time. But, you know, look at how the earnings in the, you know, people talk about, wow, market keeps going up. Well, guess what? Earnings have gone up pretty substantially, you know, over time. And there are lots of reasons. We know that. There are lots of variables, but earnings matter. And, you know, the other thing you get, you know, variability with the price earning multiples. What is the market willing to pay for earnings? That's where you get these kind of erratic moves. It's never a straight line, but again, that's part of the fun, trying to figure things out. So I think that's all I have for you from a deck presentation. Josh, can I turn it over to you?
Sure. Yeah, I'm ready. Let me
grab it.
Okay, what I'm going to do, welcome everyone. Thanks for tuning in, and thank you, Joe. So what I'm going to do is, you know, kind of show you guys around the platform a little bit. I mean, there's a lot to go into here, so I'm just going to basically focus on, you know, kind of practical application of what Joe was talking about. So,
hey, Josh.
Yep.
If I could interrupt for just 1 second, if you, because we did offer access to everybody in the platform.
Yes.
If you have access to the platform in advance of today, please just put that in the chat, if you would, just so we have some sense of how many people actually went in. Sorry, Josh, back to you.
Yeah, sure. Okay, so yeah, way too much to cover, you know, with everything here. But you know, what I'm going to show you is basically how you can, you know, trade in our virtual portfolio and start practicing, you know, different types of trades. And then, you know, I'm going to go first into our options chain. So just, you know, right down here, I already have it open. So I just pulled up this one toll because it's in one of our scanners. So Toll Brothers, it's like Home Builder. So so I just kind of want to walk through things here, you know, as far as what you're looking at. So let me get the little annotation tool. So yeah, we have the calls here on the left and the puts on the right. You can see all the blue. That's all in the money already labeled for you. And then same thing over here on the put side, all the blue is in the money, just to clear it all out. So, you know, as far as these columns, you know, we have the volume over here, open interest. You know, Joe just talked about the Greeks. So, you know, this is very important overall. And, you know, he explained it, but you can, you know, kind of monitor things here. You know, before I forget, we do have this little trick up here. It's called a time machine. So you can go back to any day and since 2007 and pull up the option screen for, you know, any of the symbols. You know, right now we have 4,061 symbols in the system. So you can pull up Apple, you know, any of them. But you can go back and look, you know, day to day. You know, it'll turn red once you're back in time. But you can go back and just kind of monitor, you know, all the Greeks day by day, and just see how things change over time. We did create an analysis for those Greeks. So let's just say we're right around the money, the 150 call. You can hit this little analysis link, and basically it'll give you the life of that contract. So whenever this January 17th, 2025 expiration, you can see it's a pretty long one overall. But you can go back and basically it'll give you all the different Greeks and their measurements over time. So you can basically do a deep dive on that strike and see, you know, how things change over time with all those. So that's a neat little tool. Then, you know, so outside of that, yeah, we have the IV, all important, bid, ask, and then mid prices. So these are all end of day prices throughout the system. You know, every night we, complete like millions of processes and update the system usually around, by 7, um, and, load up all the options tables. So this was one options table. I mean, these are all available. And, just like I said, you can go back in time and look at all this, any of these expirations. I pulled up this January because we're going to use it in the scanner. But, the other one is a strike analysis. So just going back to the at the money, if you click this 150 in the middle, it'll give you all the 150 calls and puts with every expiration listed. So you can compare that 150 call, the prices, the Greeks, everything. And, just like talking about time decay. So this one, expiration 1/15/2027, that's 976. And then, this gets higher and higher the closer you get to your expiration. The time decay, is pretty much like exponential at the end. But just another kind of cool little tool to analyze things, before you do trades. And it's just the same thing over here on the put side, the volume, obviously not a lot of volume in this issue, but, in Greeks and mid prices, and you can do the same thing with the Greek analysis, just by hitting that strike analysis, it'll do the puts for all those different Greeks. So, that was kind of the quick one. We also have all these other kind of important ranges. So this is expected move over this contract length. So until the 17th of January, they're expecting, right, priced in a 1855 move, right? So if you go to a different month, it'll be, go to December 20th, it's 1455. So, it'll get higher based off of, how long it is. And then we put standard deviation ranges, just because those are, statistically important. This is like a 95% probability of being within this range on this date. So these all change based off of your expirations too. So you got the 1 and 2 standard deviation ranges listed. Bid-ask spread, we're just, basically looking at how tight, the ranges between the bid and the ask. And, give all the strikes available. And then this also tells us how many days until the expiration. So, it updates for every contract. Some have more strikes available and others. And then daily options volume and then next earnings. So this one has earnings December 9th. And then current state. So that's our algorithm. We're not even going to get into that today, but there's the help videos down here in the YouTube. Feel free, join, subscribe, and we have the replays of our weekly meetings on there too. So, all right. So that was the only other thing here is you can do limit your view all strikes in 16. So, any questions on this options tables? As far as, I think it's a great research tool, but any questions on that right now? Yep. Just unmute yourself, just fire away.
Hi, I just have a quick question on the implied volatility. Based on what we're learning in class, volatility is usually total risk, which is standard deviation. Is it the same in this case? Because I just have seen a lot of people talk about this implied volatility crash. Sometimes even the cost in the money and the stock price went up. The actual option prices went down. So would you just elaborate that a little bit?
Yeah, that's kind of like the anomaly. Like if you kind of gauge it around earnings, right? So like the company has earnings, let's just say, tomorrow, or they announce after the close. All the implied volatilities are going to be, if it's a company that's, people follow and trade a lot, the implied volatilities are going to get really jacked up. And then, the next day, let's say it goes up $1, but, your implied volatility got cut, like in half. That's kind of what you're talking about. outside of that, like normal day to day, yeah, I mean, you can get spikes in volatility, but you always just kind of want to, know, okay, is this historically normal level, or, is this elevated, before you get into it. Joe, did you have any
So
other things on that?
In the example of the earnings, the market doesn't like uncertainty. The market, the options market, with the at the money straddle will always, and the straddle, that's the long call and the long put, it will always price in the expected move. And then once that uncertainty is out of the market, vols, sometimes they get crushed, sometimes they come down a lot. Volatility, came out of the market in a big way yesterday. If you followed the VIX, you may be familiar with the VIX.
yeah,
That's
was it the
30-day
reverse
fall.
split?
Mm-hmm.
What's that?
Sorry, I thought you were talking about the reverse split with VIX.
No,
short-term VIX.
reverse split. That's a whole different, very specialized space that is, for a minute part of, the trading community. But, the VIX generally got crushed yesterday because we got the election results in one night. And the VIX is the 30-day expected volatility, the 30-day forward look expected volatility in the S&P 500. There was a variable taking out of the market, an uncertainty, and when that happens, volatility goes down. That's how it works.
Gotcha. Thanks.
Yep.
Yeah, great question. So, okay, so next,
Sorry, Justice, and that's why, taking a look at those implied volatility charts, like Josh said, is it trading at a historic high? Is it at mid-range? Very valuable. Very valuable.
Yeah, and those you can just pull up because this is strike specific, not just like in general. This is for this specific strike, going all the way back. You can see, the volatility over time. So you can do just like quick analysis on it. Okay, so what I was going to do next, we do have these trade ideas. This is like daily trades. You can check those out on your own. What I'm going to pull up is like the trade scanner. So not necessarily like go trade these, but this is a great tool to kind of learn, how options react over time, and how your setup matters. And when you change things, you'll get different results, and it's all pretty much trade-offs once you understand that. So what I have here is a bull call. So if we go back here, like a bull call, so basically you're buying a call, let's just say the 130, and then you're selling one above it, right? So this is basically your width here is 20, then you subtract the prices and see how much the cost is. I didn't do it offhand, but I can pull it up here because I already filled it out. And this is in our virtual portfolio. I'll show you how to do that later. But so if you do the 150, sell the 150, buy the 130. You can see here your max risk 1365. Your max profit is 635. So it's like a risk the reward, like twice as much risk pretty much. Gives you a probability of profit, and then it gives you all the Greeks down here, and that's just kind of the risk reward. I think the big thing here is staying above the break-even price. But this is something you can just go into the virtual portfolio. And sorry, I'm bouncing around a little, but that's under the My Delphian. And I have a bunch, but you'll have just like one basic one here. So you can just go in here, and add position. And that's what this screen is here that I pulled up. So, and you can see here, there's a ton of different strategies that you can utilize. I'll kind of talk through some of them. But yeah, so then you just hit it save, and it's in your portfolio for, as long as you want, until expiration, or you close it out. One really cool thing with these virtual portfolios. So I have this one from September I just put in there. So this is like a Humana. So if you hit that trade down there, the position analysis, it'll give you a nice clean chart of the strikes you use, the price action, you got your profit loss over time. So it's really cool tools that you can use here. And just like everything else, you can go back in time. You know, if you want to do trades back in time, you can go all the way back as far as you want to '07 or, the previous day, so and just kind of model things and, all different types of strategies that you can do in there. So going back here to the scanner. So this is just like our algorithm, this is like a bullish transition. So, I put in the bull call, and what I did is strikes from current close. So, and then I did the above the lower standard deviation. So basically I'm just modeling it kind of like this above. So this and this kind of range as far as historically. So it'll apply this exact trade over those 41 occurrences you can see down here. So trade summary 41. So it'll do this exact setup, 60 days to expiration, like I talked about here. This one's 72, so at least 60. So this is the first one available after 60. And then, you can do your profit targets. Everything matters here. Whether it's like weekly, monthly, everything really matters on these selections, holding days, profit based off of, costs, max profit, risk, things like that. So all these things, and you can just hit the analyze and it'll run the analysis. So I just kind of, one good application for this is, as you learn these different trades, bull call, the spreads, the bull call, bull put, bear call, bear put, even just doing long calls and things like that, there's going to be trade-offs. So like here, I got profit target fit 25%, right? So you can see it's a really high win rate, 87.8%, $2,076 over 41 trades. So not too many losers, and you can scroll through the individual ones, down here. So I also ran, okay, so everything else same, I just put in a 50% profit target. So, we went from what, 87 to a 73% win rate. We made more money, but we're winning less. So you're gonna have more losers, and that's kind of part of the trade-off. Average days in trade. So we're asking for more money. So it takes longer, 39 days here. And then, for 25 is, 21 days. So, there's a lot of different metrics you can use. Like this profit factor. So that's total profits over divided by total losses. So, 3.1 there, 2.31. So you're taking more losers here. And I think one of the more important ones is how much you're making per day. So this takes longer. So you're making 64 a day on this trade, and this one you're making almost 100 per trade there. So, but get down in the weeds, and this is all different types up top. This is just different types. You can do seasonality. You can do unusual options. There's a candlesticks one in there. This isn't, it takes a little time for this thing to run just because you're doing 41 trades, based off of these setups, whatever you want to do. So, here's just like basic long call. Like Joe said, a lot of people, if you're doing calls, puts, people usually talk using deltas. So this is a 30 delta. So if we go back to our Toll Brothers chart, lower than 30, that'd be the first one. So we'd be doing 170. So it's $4.05 overall for that trade. So, but the further out you go, the harder it is to, so by January 17th or whatever it is, it's got to get up to, that 170 or you'll be losing money. So as far as other trades, are there questions you guys have? I just went through a lot of stuff. Kind of the keys are you can trade here in your virtual portfolio. There's a bunch of trade ideas, things, even like the option screener is kind of really cool. You can pull up different trade ideas. You can do a symbol looking for covered calls. Any of these, it'll find candidates for you based off your criteria. But just kind of any questions on that overall? Any specific trade types you guys want me to cover? We got a lot here, and obviously there's a lot of resources online. You get into these 4 different legs. These are like iron butterfly, iron condor. It's kind of like looking for not too much movement, and these are good trades for those earnings. The big IV crushes that were referenced earlier, setting up trades like that. But all right, any questions, comments?
Thank you so much for helping us navigate and learn this. So I had like one question. So I just saw that Fed has cut the interest rates for the second time, and if I suppose want to place a trade for say a time period of say for the next 2 months, I just want to see how post elections and post rate cut stock behaves. Could you like guide me how to place a trade over here? Like what should I do next if I want to place a trade over here?
Yeah, it's just virtual trades, but yeah, you would just go into that virtual portfolio. You'll only have one. I created all these, but you'll have one default one. So you can just select on that, and then go in, and then you can add position. And if you want to trade, SPY, just go it, select the symbol and then the strategy. So you can do, stock, you can do long calls or anything like that. And then, we have other things that can create alerts here. So, if you want to put specific profit targets that you're looking for to get an alert on or a stop loss, you can create those or, notify me after 20 days, that's kind of like the holding period. And put in your quantity and then, hit save. And then you can track them in there. So it'll be in there until you close it out.
Okay, got it. Thank you. I think we have a question on the chat. I think it's Sulaiman. Yeah.
Yeah. Yeah, the profit loss, these are based off your virtual portfolio holdings, day-to-day, end-of-day data. So I just pulled up this one because it has, 2 legs. But yeah, so this, trade got in, created you can see back here, 927. It's a bull put spread, I believe. And, it gives you your strikes, gain loss for each leg up here. But yeah, this is just end of day quotes. So day to day, you had that big drop there, you can see. But yeah, it's just a day to day profit loss based off of the options tables of, where you bought it and where it's at now. Yeah, and that's that position analysis down there. You can also put in like trade notes, like if you want to write trade notes, you can create the alert later. You can you can close one, if it's multi-leg, you can close one leg at a time. So, or you can just close it over here, if you want to, for, yesterday's close, no live data or anything. Yep, sure, no problem, Lyman. Okay. Any other questions on this? We will have this recording available, just in case. After the fact, we'll post it on our YouTube and send it out. So,
Yep.
All right. Joe, did you want to start with the stock analysis, or what do you want?
Yeah, let's see. Yeah, you want me to pull up some charts? You want to pull some up? What's your pleasure?
Yeah, you can go first. Sure. Let you go.
Okay. Let me grab, I got a few here. Let's see. I got to get rid of that, I think. Trying to get rid of the presentation so I can, okay. Let me just get rid of a couple things here, a couple different charts, okay? S&P 500, and this is a 10-year chart from 2015, or 9-year chart to current, all right? Just a couple things, and, you know, I pulled up the earnings earlier. I mean, there they are. You know, earnings are important, and just, you know, they change, you know, depending, you know, on your interests. I mean, a lot of companies have, you know, after earnings reports, conference calls, they can offer an awful lot of insight depending on how deep in the weeds you want to get. But, you know, generally, you know, the market's going up by and large because earnings have increased over time and over history. So what I pulled out here, you know, what the heck are those lines? And there are a lot of ways to analyze stocks, indexes. I love the charts, all right? Because for me, the charts, you know, everybody says, well, why did this happen? Why did that happen? There's so many possible whys. It's certainly hard to know, all right? You know, on certain days, you know, maybe there is one or two key reasons as to why something happened, but oftentimes there's just too many whys. And so the chart is that consensus pricing of all the whys, which is why I like charts. So anyway, here's a 10-year chart, 9-year chart of the S&P 500. What these lines are things called Fibonacci retracements, okay? And maybe you've heard about the 50% pullback, you know, things go up, they pull back 50%, then they go again. You know, Fibonacci was a mathematician going back, I think, to the 1600s. He's got a particular numerical cycle that is, you know, throughout civilization, and it tends to work for charts too. So you have your retracements. You know, basically you get a move, and then you look for a pullback. You know, and the ratios are 0.382, 0.5, and 0.618. And you know, the charting tool has these ratios. You know, you basically, you know, go to the top. You know, you pull down to the bottom. So where that bottom is in 2020, I mean, that was the COVID low. All right. You know, that was extraordinarily volatility in the market in the late February, mid-March period. You know, basically, you know, a lot of people thought the world was coming to an end, and it turned out to be a remarkable buying opportunity that, as you can see, had enormous legs into 2022. So, you know, that's where, you know, if you're going to get into finance professionally or even just as an investor, if you like it, try to put together rules, you know, that allow you to formulate opinions, markets overbought, oversold. You know, you don't have to get too much into the weeds, but, you know, clearly, you know, there was a leg here. You had that major low in March of 2020, and then you had the high, you know, in January, February of 2022. And that gives you, you know, you run your retracements, and it gives you potential levels for the market to pull back to potentially. And you never know whether it's going to, you know, get to a 3/8 retracement, stop at 50%, go to 618 or more. You know, there are samples and examples of that throughout, you know, finance with different charts and different, you know, companies specifically. I put the SPX because it's such a broad index. As you can see, coming out of the big time low, the COVID low, and that couple year run, we got almost a perfect 50% retracement, and then the market started to go again. You know, the major low, the last major low in the markets was, October, November of 2022. We had a big run up, and then you got another sell-off, at a considerably higher level 1 year later in October of 2023, and the market's been off to the races ever since. So just the whole Fibonacci retracement is something, I wanted to bring to your attention. A couple more charts, and then Josh, I'll turn it over to you. The chart list included Apple, Tesla, J&J, JP Morgan, Exxon, and Microsoft. Real quickly, never forget about the longer term charts. Oftentimes people look at, last 30 days, last 6 months, okay, here's Apple. All right, this is a 3-year chart. And I'm not talking about, all the state levels here. They come and go, and that's a whole different thing. But just in general, is Apple, here's Apple, okay? And here's all the way back to 2007. Well, Apple, if you remember, last fall, the news in Apple, was in the spring, all kinds of stories about problems with China. I never heard so many bad stories about Apple. And you can see right in here, the stock just languished. And then lo and behold, perception changed. I don't remember exactly what happened. You got a gap up here, which turned out to be significant because a lot of times you get a gap in the chart, stock goes up, and then it, pulls back and will fill that gap. Not even close. And then, the other thing about, Apple here, anytime it trades, up, we're talking about all-time highs in Apple. So just keep in mind the long-term charts. And I won't go through them all. Tesla, again, here's a 5-year, and here's, Tesla. Well, how about that? Tesla, when I talked about that period in, in early 2022 where the S&P topped out, how about that? Tesla looks like one of the first to top out. And, it tanked all the way into January of 23. So, that's where you can look at the broad market, but then each company has its own situation, whether it has lower lows, higher highs, important to check the charts. But how about Tesla? I mean, Tesla is just at a midpoint here, between its high in in late 22 to its low in 23. It's just straight in a mid-range. Big range, going from 400 to basically 100, but nowhere near all-time highs versus Apple. So just keep those long-term perspectives, in mind. Josh, I got some more, but I know, Kripalu, I'm not sure. We talked about going, an hour. We started a couple minutes late. I'm not sure how long you want us to go. I want to be respectful of everybody's time.
Yeah, we can just go to the Q&A. I think you gave them a good overview there.
Perspective.
The only other thing, I like to use moving averages like 50-day and 200-day, and depends on, sometimes it's 20-day.
Grab it, feel free to grab. And, the other time, getting a sense, and I call it the personality of a stock, how volatile is it? If the stock is volatile, the options obviously are going to be more expensive and you have more risk in the underlying. Get a sense for how volatile your particular stocks are. I mean, on the list, you got a broad range of stocks from a volatility standpoint. J&J, not real volatile. JP Morgan, not real volatile. Exxon, not real volatile. Apple, Tesla, and Microsoft, far more volatile. That's an important thing to have a sense of on the stocks that you follow. Back to you, Josh.
I just want to point out, like sometimes you can see like the top one, that's a 20-day EMA, the black one, like it provides like a support on the run up there. Sometimes it's 50, back here, right before the election, broke down to 20 and then, held to 50 and then popped up. So this other things you can look at, I think these are good. The retracements are great, just other ways to find kind of key levels, to be looking out for. So, but I think that we can probably just open up to, general questions or, as far as anyone, just feel free to unmute and fire away.
Yeah, about, the markets, options, the platform, whatever you like. Have we rendered you speechless?
That was an hour of action-packed stuff, Joe. So
Yes, for sure. I think thank you so much. I mean, this is definitely a refresher course, and it's just like you have been teaching us way better than what we learned, I am pretty sure. And thank you so much. I mean, you have equipped us with like knowledge with the platform and everything. And I'm pretty sure the next time we meet, I'm pretty sure we'll have like some option traders in between us as well, and we could like take it from there. Thank you so much. I really, really appreciate you guys coming in. I think the issue is, I mean, I think some of our junior students have their classes at 2:40 right now, so they might have to
yeah,
pull in. Yeah. So, but thank you so much. I
Sure.
really, really appreciate you guys coming in and helping us out, and especially like I get to learn so much. And this is my second session with you guys, but I'm still taking a lot of new things from you. Thank you so much.
yeah. All right. Well, thank you.
Yeah,
Thank you so
Kripali,
much.
thanks for organizing everything. You do a great job. Thank you.
Thank you, Josh. Thank you, Joe. Have a great
All
one.
right.
Yeah.
All right. You too.
You
Thanks.
too.
Thank you.
Bye-bye.
Thank you.